conduct a question-and-answer session, and instructions will follow at that time. Should you need assistance, please signal a conference specialist by pressing the star key followed by 0. As a reminder, this conference call is being recorded. I would now like to turn the conference over to Rory Sabino, Vice President of Investor Relations. Please go ahead, sir.
Thank you, Allison. Good morning, and thank you all for joining us in today's call. We'll start today's call with remarks from Harold Hamm, Executive Chairman, Bill Berry, Chief Executive Officer, and John Hart, Chief Financial Officer. Jack Stark, our President and Chief Operating Officer, as well as other members of management, will be available for Q&A. Today's call will contain forward-looking statements that address projections, assumptions, and guidance. Actual results may differ materially from those contained in forward-looking statements. Please refer to the company's SEC filings for additional information concerning these statements and risks. In addition, Continental does not undertake any obligation to update forward-looking statements made in this call. Finally, on the call, we will refer to certain non-GAAP financial measures. For a reconciliation of these measures to generally accepted accounting principles, please refer to the updated investor presentation that has been posted on the company's website at www.clr.com. With that, I will turn the call over to Mr. Hamm. Harold?
Yes, good morning. Thank you for joining our second quarter earnings call. First, I want to thank our employees for their hard work and dedication through this last quarter. Over the past 4 months, with the adoption of an intense testing and workplace safety protocol, they have successfully instituted a very successful voluntary return to work, and 97% of our employees are back in the office or in the field. As we have experienced, remote work delivers day-to-day maintenance okay, but it takes on-the-job collaboration to make teams flourish and create new opportunities for the company. At Continental, the morale and productivity of our employees is very high. Our employees remain focused on delivering exceptional results for the future, which you will hear about when Bill discusses our capital efficiency gains. I am very proud of our employees for overcoming the challenges faced with COVID-19 and for what we have gained in one of the most volatile quarters in this industry. We welcome the new phase of thinking about COVID-19 as the country enters a lower mortality rate experience due to better patient treatment with more effective drugs and a post-vaccine thought process of application to the most vulnerable populace. At the time of our last call, WTI was at $24 a barrel. As we anticipated, we've seen prices improve to $40 per barrel range as economies open up and people get back to work. We believe we could see this initial improvement in prices when we made the decision to curtail 70% of our operated oil volumes in May and June. Recent global crude oil inventory data, initial demand recovery, and anecdotal evidence from industry participants suggest supply and demand are rebalancing. Continental has been a leader in aligning activity with market conditions. The decisive act to defer and thereby preserve our production for the future has proven to be a value-enhancing strategy. We will continue to prioritize long-term shareholder interest over production growth for growth's sake. While we may continue to see near-term volatility, I believe ongoing inventory rebalancing in the second half of the year will position us nicely for 2021 and beyond. While market demand continues to recover, times of uncertainty can create substantial opportunity. In fact, our current share price reflects such an opportunity and uncommon value. My recent purchases demonstrate my confidence in our teams, our assets, and Continental's future potential to deliver meaningful shareholder value. There is no management team more aligned with shareholders than Continental's. While we have often highlighted this alignment, with 5 members of our management team as top 40 holders, we're incentivized to create value. This management team has always been right alongside our shareholders in driving towards a bright and prosperous future. We're all personally invested and 100% committed to doing what we can to enhance value and responsibly steward our assets and capital. During the second quarter, we were pleased to release our 2019 ESG report, which can be found on our website. This report highlights our long-standing commitment to providing a low-cost, dependable energy source in an environmentally and socially responsible manner. In fact, providing low cost of supply, dependable energy is a social responsibility of any energy company. We are proud of our commitment to developing a new ESG standard for the oil and gas industry, and will continue to responsibly manage our operations to power the United States and the world. Lastly, as part of our commitment to being a strong advocate for shareholders in the industry, I became a founding member of the American Gulf Coast Select Best Practices Task Force Association. Our goal was to establish a new competitive standard to accurately reflect the fair market value of the American barrel to the global market. The market was clearly broken when WTI prices fell into negative territory earlier this year. We've asked the CFTC to investigate, and they have. Their report is forthcoming in the coming months for their chairman, Heath Tarbert, as reported by Bloomberg. This extreme discounting of the U.S. oil and gas industry led us to form AGS. In June, 2 leading pricing agencies, Platts and Argus, established this benchmark to more accurately and reliably price U.S. light sweet crude. AGS is not a replacement for WTI, but it's a confirmation to the world that the American energy renaissance has gone global, and AGS will provide U.S. producers with a waterborne price barrel. Despite headwinds faced this year, now is not the time to count out U.S. independent producers from being key future net exporters of crude, and I firmly believe Continental is well positioned to be a leader in this phase of the global hydrocarbon business. I am proud of the progress made to date to establish a stable market for American-produced oil. I would now like to turn the call over to Bill.
Thank you, Harold, and good morning, everyone. Hope you're all well and safe. Continental demonstrated a proactive first-mover response to the unprecedented events that have shaped the global commodity landscape in 2020. As you can see on slide 3, we have prudently responded to demand destruction attributable to COVID by preserving this production for a better market environment. The deferral of approximately 55% of operated oil volumes during the second quarter is estimated to generate about $90 million in incremental future cash flows from operations at $40 WTI. Even after shutting in these volumes, we are reinstating original per unit cost guidance for the year, reflecting our low-cost, capital-efficient assets. Our priorities continue to be protecting our balance sheet, maximizing cash flow, preserving our world-class assets for future shareholder value, and maintaining our commitment to low-cost industry leadership. As part of this, we expect to see total debt between $5.4 and $5.5 billion by year-end 2020. Beyond 2020, for our longer-term debt stewardship, we are targeting $4 billion or less over the next 3 to 5 years, assuming a $50 price environment. John will provide more details about our expectations for these sequential reductions. Our team's continuous improvements and abilities consistently delivers material gains and cost efficiency. I'd like to congratulate them once again on a job well done. As evidenced on slide 6, we expect capital efficiencies to increase across both the Bakken and the South in 2020. In the Bakken, we have achieved a 12% reduction to completed well costs from $8.2 million to $7.2 million per well. In the South, we've achieved a 10% reduction to our overall South completed well cost from $10.5 million to $9.5 million per well. 70% of these reductions are structural in the Bakken, and 80% of these reductions are structural in the South, driven by all aspects of our operations. Both the Bakken and South completed well costs include drilling, completion, full facility costs, including artificial lift. These improvements are coming from drilling execution practices, completion design optimization, and improved operational efficiencies related to coiled tubing cleanouts, as well as higher utilization and performance of gas lift production operations. As Harold mentioned, our employee morale, enthusiasm, and productivity is extremely high in spite of these challenging times. Our employees are the foundation of our company, and we view keeping our teams together as a distinct competitive advantage. This is a part of our DNA and has enabled us to differentially manage and leverage our world-class operations to continue our best-in-class performance. As we look forward, there are a number of factors positioning us for a strong second half of 2020 and beyond. Here are a few key items. First, in terms of our production cadence, recall previously when we provided guidance of our second quarter production in June, we also highlighted July production of about 225,000 to 250,000 BOE per day. Actual July volumes will be in line with this guidance, and we expect to bring the remaining curtailed volumes back online this month, with the exception of approximately 65 million net cubic feet per day of dry gas volumes in Oklahoma we have deferred in expectation of more favorable market conditions. While we do not normally guide production on a quarterly basis, we thought it was appropriate to provide some color given what has transpired year to date. We expect third quarter production to range between 280 and 300,000 BOE per day. Consequently, production will increase in the second half of 2020, and we expect to exit the year at 310 to 330,000 BOE per day. Second, we will be cash flow positive in 2020 and project approximately $200 million of free cash flow for the full year 2020 at $40 WTI, or $500 million in the second half of 2020. Our first priority with incremental discretionary cash flow will be to continue paying down debt. If we see supply and demand align to a more sustainable level, we have the ability to consider a managed increase in completion activity along with additional debt reduction. As of June 30th, we have about 215 wells in progress and expect to end the year with about 140 wells in progress. Third, as a result of the aforementioned cost efficiencies, our team continued to drive maintenance capital lower. That, along with the 140 wells expected to be in progress at year-end, will enable us to keep our 2021 production flat year over year, with a maintenance capital of $1.2 billion or lower in 2021. Fourth, with a lower level of activity, our corporate first-year decline rate in 2021 will be in the low 30s compared to the upper 30s in 2020. We are well positioned to efficiently maintain production in 2021. We will continue monitoring near-term market conditions and expect to provide 2021 guidance around our usual historical time frame early next year. Despite the challenges we have faced this year, we have kept our teams together just as we have done in previous downturns. As a result, we continue to drive our well costs and our operating costs lower, and our unique combination of inventory depth, workforce stability, technical capabilities, and management alignment will enable us to deliver future shareholder value in virtually any market environment. I'll now turn the call over to John.
Thank you, Bill, and good morning, everyone. Some of you had questions on maintenance capital. Maintenance capital is intended to help you in calibrating your models for our capital efficiencies, but is not intended as guidance for 2021. We will provide full guidance for 2021 in February, reflecting the full extent of our plans. Our expected multi-year maintenance capital to hold production flat year over year in 2021 is $1.2 billion or below for drilling and completion. Whether you are considering year over year or fourth quarter exit production, the level of maintenance capital to hold these figures flat in 2021 is essentially the same. As we typically look at maintenance capital on a multi-year basis, I will point out that our $1.2 billion estimate includes slightly in excess of $400 million of capital that does not see first production until 2022. So if you're considering a one-year maintenance capital, it's below $800 million for drilling and completion. If you, like us, are more interested in a multi-year look, we estimate that we could hold production flat for $1.2 billion for multiple years. These numbers reflect well cost efficiencies, as previously noted in the Bakken and Oklahoma. Our multi-year look is a 30% or more reduction from our previous estimate of $1.5 to $2 billion. Let me review a snapshot of several key second quarter financial performance metrics. Despite curtailing approximately 55% of our operated oil volumes, LOE per BOE came in at $3.58, which is within our previously suspended guidance range. While G&A per BOE was slightly higher due to production volumes being curtailed in the second quarter, we expect G&A to revert lower on the balance of this year and be within our original guidance as production is resumed. Even at a slightly elevated level per unit, our second quarter G&A trends below our broader peer set. Our G&A highlights the lean nature of our organization and the sustainable operational efficiencies we deliver. As part of our continued financial stewardship, we have paid down approximately $1.4 billion of debt since the beginning of 2016, and our commitment to a strong balance sheet continues. On the back of lower commodity prices and curtailed production, our net debt increased slightly in the second quarter. Based on our current forecast, we believe our total debt has peaked in July and should decline through the balance of 2020 and continue during 2021 and beyond. Based on current commodity strips, we expect to exit this year with debt between $5.4 billion and $5.5 billion. Our longer-term debt reduction goals remain on track, and we expect total debt to approach or drop below $5 billion by year-end 2021. As Bill mentioned, and as we've said in previous years, our ultimate debt target is to be comfortably below $4 billion. We have a proven track record of debt paydown and financial strength, and this will continue. While COVID caused a momentary blip, it has not impacted our strategy. Our revised 2020 guidance metrics further highlight our commitment to shareholder value and cost leadership. 2020 CapEx is expected to be on budget at $1.2 billion or lower. The significant transition between first quarter CapEx of $651 million and the second quarter of $191 million is an indication of how quickly we have adjusted to a lower level of capital activity. Third quarter and fourth quarter are expected to be lower yet, putting us on track for an annual budget of $1.2 billion or below. We remain committed to capital discipline. As Bill mentioned, we expect positive annual free cash flow of approximately $200 million at $40 WTI. Said more directly, this means we expect positive cash flow of approximately $500 million for the second half of 2020 at current strip prices. This is the catalyst to reduce debt this year and into 2021. We are also reinstituting previously suspended operating expense guidance for LOE, G&A, and DD&A, reflecting continued cost controls, productivity, and capital efficiency from our assets. Our guidance and expectations are a reflection of Continental's exceptional capital efficiency and focus on value creation. To be on track with our original guidance after all that 2020 has brought is an accomplishment that we are particularly proud of. With that, we're ready to begin the Q&A section of our call, and I'll turn it back over to the operator. Thank you, everyone.
Thank you, sir. And we will now begin the question and answer session. To ask a question, you may press star and then 1 on your touch-tone phone. If you are using a speakerphone, please pick up your handset before pressing the keys. To withdraw your question, please press star then 2. In the interest of time, we ask participants to limit themselves to one question and one follow-up. At this time, we will pause momentarily to assemble our roster. The first question today will come from Derek Whitfield of Stifel. Please go ahead.
Thanks. Good morning, all.
Hello, Derek.
Perhaps for Harold or Bill, how do you philosophically think about growth rates and reinvestment? It's clear a lower growth, higher return of capital business model is the right approach at current pricing. How does that change in a $50 or $60 world?
Yeah, I think, Derek, if you saw what we were doing early in the year, we were saying essentially that, and early on, that we should not be, as an industry, overproducing into an oversupplied market, and we saw it, and we started attenuating our growth rates at that point in time. And as you look at, what's going to take to bring back activity, you're probably in that $50, $60 world. And so until that point in time, I think the industry will be pursuing pretty moderate growth rates if that's what you're trying to get a feel for.
That is, and then as my follow-up and more specific to what you've outlined in your presentation today, with regard to your 2021 maintenance capital outlook on page 3, could you outline the broad activity and well cost assumptions embedded in that estimate?
Yeah, and I'll ask John or Jack to put in comments here as well. But embedded in that, and you're probably looking at what type of cadence as far as drilling. That's got about 7 rigs in that as far as a drilling program. And intentionally, we're not specifying north and south because with our product, we'll have a little bit of flexibility built into whether we're drilling north or south, but you could start off saying kind of half and half. And John or Jack, you got anything to add to that?
No, I mean, we've assumed the well cost assumptions that we've outlaid to you. Obviously, the Bakken and the South, what Pat and our broader operating teams have done is tremendous there. That's giving us a lot of benefit. We've also given you color today on a 1-year versus a multi-year. I think a lot of times companies just talk about what they can do from 1 year to the next. Well, you've got a steady state going on of operations where you're drilling and completing and things are coming on at a later time. So we try to give you a lot of color than that. With our low overhead structure and with the capital efficiencies that we garner, we're very well positioned.
Yeah, and I'll just add too, this is Jack, the inventory that we've got built in is just top shelf inventory for the company, and we'll continue to expect just excellent results.
Very helpful. Thanks, guys.
Thanks, Derek.
Our next question today will come from Doug Leggett of Bank of America. Please go ahead.
Well, thanks. Good morning, fellas, and I hope everybody's doing well out there. John, these are probably for you, if you don't mind. Two questions. One is clarification. So you've been very clear about the $1.2 billion and the $800 million of that is activity in 2021, but I'm a little confused by the production guidance. So you exit this year 310 to 330. Is that fourth quarter or actual exit? I know it's a bit of semantics, but the implication is if you hold 2020 flat at 295, there's some implied decline through the year. So can you just clarify what you meant by hold exit flat or hold full year flat? The number is the
Sure.
same. I'm a little confused by that.
Well, first of all, happy anniversary to you and your wife.
Thank you.
And secondly, we modeled that maintenance capital is at slightly higher than that 295. It's 300 or above. So the level of maintenance capital, whether you're looking at 310 to 330 or whether you're looking at 300 or a little bit above, you're not getting a big dollar difference in maintenance capital. So they're essentially the same. Does that help you? Does that help on your?
Just to be, it kind of does, John. And thank you for the for the good wishes. But just to be clear, so we are to get to 295 would imply just a moderate decline through 2021. Is that the right way to think about it?
It'd be a moderate decline off that fourth quarter exit. But again, we're not providing full 2021 guidance. That'll come out in February. And you're in a very narrow range of production for us. You've seen us bring production on very easily in those general ranges.
Great stuff. And my follow-up is, that's a massive step down in sustaining capital. And you know how we think about the world is, what is the portfolio capable of generating by way of free cash flow? So if you could just help us a little, or help me a little bit do the simple math. As you step up your capital back to that 1.2 billion level, what do you see as your oil break even to give us an idea of what the portfolio can do by way of free cash flow? And I'll leave it there. Thanks.
On a cash flow basis?
For covering the 1.2 billion capex, I guess.
And you're talking about a 2021 number on a full year basis?
That
or are
would
you
be
talking
helpful.
about the balance of this year?
For
The balance
2021.
of this year for free cash flow is in the mid to low $20 price. We can generate, neutral for free cash flow. As you look out into 2021, if you're at a full 1.2 billion, it'd be somewhere in the upper 30s, low 40s.
So
on
$50
WTI.
you were through, our base case is BFA.
At $50, we're putting off a significant amount of free cash flow, hundreds of millions.
Okay, we can take it from there. Thanks very much, John. Congrats, guys.
Yeah, you're welcome. Happy anniversary again.
Our next question today will come from Jeanine Wei of Barclays. Please go ahead.
Hi, good morning, good afternoon, everyone.
Hello.
Good morning.
Good morning. So I guess my first question is just back to the 2021 maintenance CapEx. We really appreciate all the updated detail on disclosure for capital efficiency purposes. In terms of non-D&C portion of it, can you provide any color on maybe how that would trend next year generally? Is there anything that biases that of leasehold facilities and others that earmarked for 2020? Is there anything that biases that either higher or lower next year?
Yeah, I think that's a fair question. There are a number of components in that non-D&C, so let's kind of break those into segments. First one is obviously our mineral activity, and that's something that we, along with our with Franco-Nevada, we agree on that. Now, from a cash flow perspective that they're covering 80% of the expenditures, so albeit it's a gross up on our capital dollars, it's not from a net cash perspective the same because of that carry that they have. That ultimately depends on what we see in the markets out there. Currently, we're not that active on the mineral side. We've taken a little bit, we've slowed down our level of activity. So what we ultimately budget for that, if it's in the current price environment, we'll see if we continue at this lower price or if we go back to something closer to what we were before. But that's roughly $100 million or so a year, and we're not spending anywhere near that in the current run rate. And what we do again will depend on what we see in the markets as we go forward, where we're choosing to invest. The other factors in their facilities, they're a component of what we're doing on the D&C side. So, if we're at a 1.2, we would probably be comparable or less than what we're at this year. And leasehold and land, the biggest part of that, that ebbs from year to year depending on exploration activity or renewals. I'll say I don't think we have a significant amount of renewals coming due next year, and beyond that it would depend on new plays or new opportunities. That's something that we'll obviously give you a lot more color on when we get around to full guidance in February.
Okay, great. That's a lot of detail. Thank you very much. I hope you can hear me. You were breaking up a little bit for me, but it might have been on my end with the storms here. But my second question is
You're
just a
coming
little
through
bit
clearly
on...
here.
Oh, perfect. Okay, great. My second question is just a little bit more on the housekeeping side, if you don't mind, and it's on oil percent. Continental's oil percent was understandably low in Q2 due to the nature of the production shut-ins. But with the shut-ins coming back online and resuming a lot of completions or resuming completions in the back end, can you provide any color on where the oil percent may migrate to in the near term and maybe how long it takes to get to the levels of activity? I know that the focus is
Hey,
kind of
Jeanine?
on EOs. Yes, hello?
Jeanine, it's Rory. You're breaking up a little bit on us, so we didn't get the second part of that question. We did get the first part with regards to the oil percentage, but the second part we did not get. If you could just repeat that.
Oh, it's all the same. It was just if you can provide any color on when the oil percent might migrate to historical levels, and understanding that you've got a lot of flexibility between oil and gas depending on where the commodities move for each of those.
Yeah, well, Janine, this is Jack, and the oil percentage, we'll go right back to where we were in the first quarter. We were like 56% in the first quarter, so basically we shut the oil in, we turn it back on, we go right back to where we were, so there's no real material change there at all. And on top of that, I'd say there has been discussion, about will these wells come back on, industry-wide and all, and I got to tell you, we're seeing just pretty impressive flush production coming out of these wells when we turn them back on, and that's what we've experienced previously. That's why we were never concerned about how these wells would perform, even though there was a lot of chatter about it. And I guess there's a good example out in Montana. We shut in all of our Montana production out there, and we had it shut in for about 2 months, and we turned it back on, and the production was double of what it was before we shut it in. And so, so what we saw is some significant production, flush production, related to that whole field. And so you can look at it on a field basis, or you can look at it on a well basis. Bottom line is the oil's there, and these reservoirs are performing very nicely for us.
Great. Thank you very much, gentlemen.
Mm-hmm.
Thank you.
Our next question will come from Arun Jayaram of J.P. Morgan. Please go ahead.
Yeah, Harold, I wanted to start with you. I was wondering if you could give us your perspective on the surprise judge's order in July to potentially shut down the DAPL pipeline, and your thoughts on what happens from here.
Well, we feel very good that order will be stayed. It's this thing as we heard. We felt good that we'd have an initial stay, which we got, and we are very confident that this panel will also stay this thing again. And in the end, we feel like that this pipeline will continue as it's operated 3 years trouble-free up there. So it's a good thing